Thank you, Wayne, for that introduction. If you can't hear me at any point, please let me know. This does not work. But thank you for having us here today. We are here to talk about a profile of changing risk in the building and construction industry. My name is Renee Dobson and I'm the General Manager of NCI. I've been with NCI now for 14 years. Had several different roles during that time. I've even worked in our Auckland office. And joining me today is Maria, who is our Manager of Client Service and has been with NCI for 5 years now. And prior to NCI, she was the credit manager for one of our clients for many, many years. Before we start, I would just like to ask how many of you have had a bad debt over the last 6 months? Just a show of hands is fine. Yep, good. And leading up to the insolvency, did you have many warning signs that these companies were going to fall over?
A couple of them we didn't.
Mm-hmm.
They were really good payers and then they went like that.
Yep.
The last one was just kids and they promised and promised and then they went.
Yep.
Sorry.
No worries. And we'll touch on that a little bit more as we go on. But today we'll provide you with an update on what we are seeing in the building and construction sector. And we are keen to hear from you on the challenges you may be currently facing and concerns for the coming months. We'll share some statistics gathered from clients, discuss how NCI assess risk and provide you with some key takeaways. So just before we get into the spicy stuff, we wanted to give you some background on NCI for those of you who are not familiar with us. And NCI have been established for 37 years and we hold approximately 70% of the trade credit insurance market, and the building and construction sector makes up almost half of our portfolio. NCI offer a range of products to assist our clients with their credit management processes. And whilst we specialise predominantly in trade credit insurance, we do offer other services to help manage your credit risk. From onboarding your clients with our online credit applications, assessing your customers, all the way through to collecting your debt via our commercial collections team.
Thanks, Renee, for the introduction. The products and services Renee has mentioned are an integral part of our business. However, most importantly, we at NCI pride ourselves on how we work closely with our clients, providing solutions for the ever-changing market we operate in. I recently read a book called Legacy by James Kerr. This is a book about the All Blacks, and I am assuming most of you guys know who these people are. If not, they're the world's most successful sporting team. The book shares some really useful references and practical takeaways for businesses around resilience, organisation and culture. I would like to share with you a small selection of text from the book. Maui, he's the discoverer of fire. Maui was spearing birds with his brothers one day. However, his spear had no barbs, and their prey escaped them. Maui's mother told him to use sticks to create barbs for his weapon. He did this, and they feasted on pigeon that evening. The message here is not just that mums know best, but how we need to learn to adapt to our environment. The current economic climate can change quickly. It is important to us at NCI we are always available for our clients to help navigate and adapt to these changes. Now for some statistics. Firstly, we wanted to provide you with some data around claims versus ASIC insolvencies and how this is tracking, not just in Australia, but also in the UK. The purpose for showing you this comparison is we tend to find Australia closely follows the UK in trends. In this graph, we are comparing ASIC external administrations versus NCI claims received between 2019 and 2022. What you will notice is that we are starting to see claim levels increasing and returning to pre-pandemic levels, and our expectation is that this will continue over the next 12 months. This graph shows the number of registered company insolvencies in the UK. You will note in July 2022, this was actually higher than pre-pandemic levels, which was driven by a higher number of creditors' voluntary liquidations. During COVID, there was clearly a drop in insolvencies. Locally, however, we still saw a negative reaction from the insurers. They felt as though they needed to reprice premiums and take a hard stance on approving cover. They were predicting doom and gloom well before any obvious signs the market was starting to turn. Here we are, almost 3 years later, and we are now just starting to see an impact from COVID and a number of other contributing factors such as price increases, material and labour shortages. Cover on debtors became increasingly difficult to obtain as the insurers were insisting on additional information to approve limits, such as recent year financials and firm orders, to justify the limit request. This made it challenging for our clients, as they often will apply for a limit to ensure they can have the cover before accepting an order. The insurers have appeared to have softened slightly in their approach. However, the requirement for recent year financials is still very common. Recently, we conducted a survey across hundreds of NCI clients asking CFOs what their top 3 concerns were for 2022. The outcome from this survey were 1. Sourcing materials and the increase in the cost of goods. 2. Labour shortages. And 3. Overdue debts with customer non-payment. Whilst sourcing materials and costs as well as transportation factors are easing, labour shortages and overdue debts appear to be ongoing factors we are all dealing with. So let's take a look at our claims statistics, in particular this last financial year. This graph shows there has been an overall increase in the number of claims since January 2022. A large number of these claims have been a result of the recent insolvencies on Privium Homes, ProBuild, Condev Constructions, Pivotal Homes, and Oracle Building Corporation. Without a doubt, these insolvencies will have flow-on effects to other businesses in the industry, not just to the 50 or so NCI clients that have reported losses, but more so to those that deal with other suppliers. This domino effect, we predict, will mean the number of insolvencies will grow. Businesses will experience tighter cash flow, and many will have to seek additional work to recoup these losses. Depending on the outcome, more work will need to be sourced, which could mean taking on more risky projects, ultimately placing a higher risk on businesses. Let's have a look at some specific statistics on some of these recent insolvencies. And just to put this in perspective, these figures are based on NCI clients only and doesn't take into account other brokers and policies direct with insurers. If we just take a closer look at ProBuild, this was one of Australia's largest construction companies. ProBuild was showing no obvious signs of distress. Their payments were all up to date, and then, pretty much, overnight, tools down, everyone off site. We had 57 clients affected with $37 million in cover in place. We were able to assist our clients with $8 million in claim payments, which was a great result. The majority of these large companies, however, became insolvent overnight. We would typically see noticeable signs of deterioration. For example, overdue client reports, repayment arrangements, and collection activity. Unforeseen insolvencies have always been an issue. However, we are starting to see these in larger volumes and on a greater scale. If we break this down and take a closer look at how many claims we have received this year by industry sector, you will note building and hardware have the greatest amount of claims received year to date, nearly 12 million. This is closely followed by the electrical sector and the labour hire sector, predominantly relating to building and construction industry. As a compliance requirement for an insurance policy, clients are expected to report on debtors who have not paid by a certain period. This is dependent on insurer and policyholder. The breakdown of this graph depicts specifically in the steel, building and construction sector from Q1 2018 to Q1 2022. It highlights the number of debtors being reported along with an accumulative dollar value. There has been a gradual increase both in the number of debts reported and the dollar value since Q2 2021 to Q1 2022. This is a reliable indicator of where claim volumes may be heading over the next 12 months. NCI's Commercial Collections Division recently reported an increase in collection activity. This, combined with the overdue reporting, indicates businesses are struggling with collecting their debts, which will put pressure on cash flow. Over the past 12 months, we saw a reduction in our collection activity. However, as we just mentioned, we are starting to see this increase again. Over the pandemic, a lot of businesses had surplus funds for cash transactions, which was helped by the government subsidies over the COVID period. Together with the help of these subsidies, there is a belief that some businesses were showing compassion when pursuing their debts through the lockdowns due to the trying times we were all facing.
So let us look at some key factors NCI used to assess risk. NCI and insurers assess risk on a debtor's individual risk profile. We do not take into account other debtors' performance or if they hold an insurance policy or if policyholders' performance. There are a number of different reports and information available which is used when assessing risk. However, before we get to these, I think we can all agree an updated credit application is key with a guaranteed document and clear terms of trade. This is extremely important, and fortunately we have a lot of our clients who have used one of these through Results Legal. Thank you. So let us look at the 5 C's. So the first one's character. When assessing character, we take into account points like, is the customer likely to pay? What is the debtor's attitude to creditors? Does a company's success depend on one or more key managers? Won't go through all of those, but the capacity. Does the customer have the facilities in place to meet their financial obligations? Are the trade references we source supportive of their capacity to pay? Does their payment history and ledger experience demonstrate their ability to service their debt? And we'll also request financial statements to help us to support our assessment as much as possible. Next one is capital. How much money is invested? We assess and understand the level of risk the customer is willing to accept to ensure the success of the business. We then delve more deeply into the financial statements, clarifying any queries that we have. And the collateral. We determine what securities the business or the directors have provided, then assess what types of personal and business assets are the customer willing to put forward as additional security if the business cannot repay their debts. And lastly, the conditions in the economy. We look at the industry sector. Is a debtor in a highly competitive industry? Will they be affected by seasonal factors? And what type of market share do they hold, and how long have they been established in the market? When we're doing a financial analysis, we are performing to check their net worth, in particular their tangible net worth. Ensure the company has good working capital or liquidity. Check the bottom line. Are they making a profit or a loss? And of course, cash is king. Cash flow is critical to a business. We also obtain annual audited accounts where possible or interim results and compare these results and ratios to previous years to look for any trends. Is there a heavy reliance on overdraft facilities or cash flow? Be aware of intercompany loans, director loans and drawings, and also check additions on unaudited accounts. Oh, sorry, that's you.
So what are the insurers' thoughts on the future outlook? Well, currently all insurers are open for new business. As some of you in this room would be most aware, insurers avoided accepting new policies during the 2020 to 2021 period, with a priority to support their existing clients with policies. The majority have an expectation of increasing claims. However, at this time, the premium rates have remained steady since 2021, dependent, of course, on individual policy performance and industry sector. So what does the future hold? Well, NCI doesn't have a crystal ball. However, what we do know is that the government stimulus packages have been reduced. We know that ATO are taking action to recover their debts. We know interest rates are increasing and the banks have started to restrict lending. Also, forecasts have predicted possibly another wet season, which will impact various industries, specifically building and construction. Can I ask if anybody else has a comment of any other major influencing factors which would relate to the building and construction sector they'd like to share? Maria?
Licensing.
Yeah,
Sorry. Licensing, I think.
Yeah.
I had a call from someone in the construction industry last week asking me how to look at suspensions and cancellations, because even though they are a credit manager in the industry, they weren't aware that you can go onto the QBCC website, and for those who are a member of the Bureau, we can actually access that through our red alerts.
Awesome. Good. Thanks, Maria. Anybody else?
Just a question, Maria. It's interesting that before any impact of COVID was evident, the insurers either sort of cut cover or increase premium. Now that the impacts are becoming evident, you said that they're keeping their pricing fairly stable. Do the insurers know something that we don't, or is their pricing a bit sort of playing catch up, do you think?
Yeah, it's stable at the moment. I think from the increase in 2020, like there was increases across the board, and then in 2021 to now, it has been fairly stable, of course. And like I said, that does depend on individual policy performance and sector. But when we see insolvency starting to increase again, then that will have an effect on rates.
Like they're not pricing. It seems like they're not pricing preemptively, but will play catch up after the fact.
Yeah. They did price preemptively, basically, and then they realised that the insolvencies didn't happen, so they can't get another increase now. But we do expect probably over the next 12 months, if insolvencies continue this way, that we will start to see a spike. But they recognise that they overreacted and put premiums up way too early than what they should have.
Yeah.
I've got the mic.
Oh, I can yell. Have you seen many of the insurers, just based on the last couple of years, putting further restrictions on their policyholders?
Question is, have you seen any of the insurers put any further conditions with respect to their insureds around security and things like that, based on what we've seen in the last couple of years? Like, are they insisting on their insureds register their PPS or take additional security and things like that?
There has been some for the PPSR registrations, depending on which debtor it is.
Case by case.
Yeah. Thanks, Anna.
Can I ask a question?
Okay.
I've got a couple.
Okay.
So I'm interested, so we know that the world is in an inflationary spiral.
Yes.
Australia at the moment is looking pretty good compared to most Western economies. You seem to look at British, UK data, and we're seeing inflationary rates, I think, over 10% now. So obviously that's going to impact there, and it will impact here. Borrowing costs are going up as well. So the material prices are still going up, independent of the inflationary pressures that are out there. But we've also got the factor in the weather here in Australia. I mean, this La Nina that's around at the moment with extremely heavy rain for most of the summer, or all of the summer. So that must factor in the way an insurance company would be viewing risk.
Yes. Absolutely, and it depends on what sector you're in as well. They certainly take that into account. Thanks, Wayne. So just moving on, Max Advisory is a South Australian insolvency practitioner firm, and they report that the ATO has had an outstanding debt of $61 billion, which is up $40 billion from 3 years ago. And the majority of this is owed by SMEs. As the ATO accelerates post-pandemic debt recovery, issuing monthly as many wind-up notices as were issued over the past 2 years. Compared with the same time last year, an extra $2 billion in debt has been collected from SMEs after company directors were warned of personal liability for their company's unpaid tax liabilities. ASIC data revealed in September 2022 there were 192 external administrations, compared with 93 the same time last year. Driven by improved digitalisation, the ATO issued over the past 6 months approximately 60,000 notices to directors of more than 45,000 companies. Their intention was to make directors aware of their company's tax debt, when often they didn't know. Director penalty notices have been used to drive awareness to directors of their personal obligations. Max Advisory believe the resumption of normal debt collecting by banks and the ATO, combined with inflation with the impact of supply and demand, along with the desire for the RBA to continue to rise interest rates to combat inflation, is creating increased cash flow pressures on businesses. This is sparking increased insolvencies. By the start of 2022-2023 financial year, the tide of insolvencies had turned, surging to more than 500 a month.
So we would like to provide you with 5 key takeaways today to help minimise the impact insolvencies may have on your business. Number 1, knowing your customer. Conduct a wash of your customer's age trial balance to make sure no changes have occurred to your customer's business structure over the last 2 years. Monitor your customers against changes or adverse events. By monitoring your customers, you can receive early warning signs and alerts which may save you from getting caught by a financially distressed customer. Register your security interests. If you supply goods, ensure you are protected in the event of an insolvency to have the means to recover your goods not paid for or negotiate with an administrator on recoveries for those goods. Number 4, conduct annual credit assessments. Don't set and forget credit limits with your customers. Build in an annual review to check if anything has changed with their financial health. And number 5, if you haven't already, consider trade credit insurance. Most businesses insure against theft or their stock of their premises burning down, so why not protect yourself against the event of one of your customers becoming insolvent or not paying you? Renee would like to thank you so much for having us here today, and we hope you found our session informative. So please, if you have any other questions, let us know.